Introducing Meta Ray-Ban Display, the world's most advanced AI glasses. With a full color display built into the lens of the glasses, it's there when you need it and gone when you don't. Send and receive messages, translate or caption live conversations, collaborate with Meta AI, and more. Be one of the first to try Meta Ray-Ban Display. Visit meta.com/Meta Ray-Ban Display to book a demo and find your pair.
Reality radio for a really great future. We're talking real money.
Well, happy holidays, Talking Real Money listeners. Merry Christmas, Happy Hanukkah, happy everything. Happy, just happy times. I'm Don McDonald, and this is the Friday Q&A podcast on Talking Real Money, where you send in questions at talkingrealmoney.com, and then I answer them. And by the way, before we get started on the questions, I have a little Christmas gift for all of you. Okay, I didn't go out and get you something special, but I did gather together all of my holiday short story podcasts in one new podcast that'll be there all the time. It's called Seasons Readings. Seasons Readings as in Seasons Greetings, but Seasons Readings because I'm reading stories. In there are a couple of my very first Christmas stories, original ones that I wrote. So those are there along with a bunch of other classic stories. And the Christmas gift part is that they're all airing commercial free until the day after Christmas. So if you want to hear some Christmas stories, go to any podcast service and look up Seasons Readings. It's, by the way, this is really, this blew me away. Apple decided to feature Seasons Readings as one of their favorite new podcasts, and I am now the number 4, or at least when I recorded this, I was the number 4 podcast on Apple Podcasts under fiction. I beat out Hugh Bonneville, Lord Grantham, that guy. Julie Andrews is still ahead of me, but hey, it's Julie Andrews. So anyway, we're here for the Q&A session, and thanks for listening. And you can just easily ask your questions anytime by going to talkingrealmoney.com, click on the contact form, and then record your question. That gets them on the Friday Q&A podcast. Now, let's get our first question, shall we?
Hello, Tom and Don. I love your podcast and listen to it all the time. I have the following questions about a multi-year guaranteed annuity. First, how safe are these? I checked in North Carolina, and they are guaranteed up to $300,000 if the insurance company is licensed to do business in North Carolina. Number 2, how do these compare to CDs? 3, would an annuity ladder be as good and safe as a CD ladder? And if you have any further pros and cons of each one, I would like to hear them. Thank you very much for your time.
Well, fixed rate annuities, which is the kind you're talking about, they're relatively safe. We certainly put them in the safe category, and they yield a little bit more than CDs because they're a little bit more risky. Anytime you have a backing by an individual company, which is the first line of defense with annuities, that's the company, your guarantee is not as strong as the full faith and credit of the United States government. The state guarantee is a lot stronger, but it is also guaranteed by a pool, an insurance pool. I don't believe it's a full faith and credit guarantee by the state of North Carolina, because I don't think most of these are. They are insurance pools. They are guarantee pools. Now they are, I believe, most of them are technically backed by the rest of the insurance industry. In other words, if an insurance company went out of business and couldn't pay you, then the state guarantee would do so, and then it would reconstitute itself by charging higher premiums to all of the other insurance companies in the state, much like homeowners insurance or car insurance works for us. If there are a lot of claims in your state, then homeowners who didn't get affected will pick up the losses that weren't covered by the insurance company. So they're safer. They're pretty safe, not Treasury or CD safe. but pretty safe. I'm still sticking with a CD ladder, but an annuity ladder, I guess, would be okay. I mean, in terms of safety, it's going to be pretty darn safe. Thanks for the question. We really appreciate it. We've got a lot more coming up, and all of these were sent in at talkingrealmoney.com on the contact form. So if you have a question, please send it, speak it, preferably for the Friday podcast. That way you always know when it's going to get answered. If you type them up, could be any of the podcasts, which forces you to listen all the time, which now come to think of it is probably a pretty good thing. Okay, let's get to the next question.
Hi, Don. This is Brandon in Atlanta with a question. My wife, 37, and I, 42, recently moved from a state with no income tax to a state with an income tax. We are also about to receive a bonus payout that we were not expecting. We have a long-term plan in place, and the money will be put to good use quickly. But there's a chunk of money, about $30K, that exceeds all of our current plans. We don't anticipate needing the money until retirement, and we have plenty of flexible money in brokerage and savings. So here's what I want to do. If we each drop $15,000 into a 529 plan with the other as a beneficiary, we'll cut our state taxes this year. Then we leave the money there for the 15-year clock to run, of course, tax-free that whole time. And then when that runs out, we should each have about $35,000 conservatively to roll over to Roth IRAs. If we end up not needing the money, we have plenty of potential beneficiaries in the family that we could roll the 529s over to that could use the money for college or other education expenses. So I don't really see a downside to this other than the complexity. Am I being crazy? Is this too complex to be worth it? Thanks.
It's complex. Too complex to be worth it, though. It's pretty creative. And the only thing that makes it better than just doing a backdoor Roth is the fact that Georgia gives a married couple $8,000. I think it's $8,000 in a state tax deduction per person, I think. But it has to be in the I believe it has to be in the Georgia 529. And the Georgia 529 it's managed by TIA. But you could get age-based funds or target. Well, no, you wouldn't need those. You're both adults. You could use equity, stock-oriented index funds for that 15-year time frame. So I guess the first $8,000 contribution would then have a 15-year wait, and then you'd have another 15 years after the next contribution the next year. So total of about 16 years that it has to park there. But that's okay because you can only move it to a Roth in whatever the limit is for the Roth. Now remember, to move it to a Roth, the beneficiary of the plan, has to have earned income. Now, you both should be still in earning years, but you will both need to have earned income to make that Roth contribution in those years. But on the face of it, it sounds like it works, I think. I mean, the devil's in the details, but again, the only thing that makes it worthwhile, and it's a minor benefit, but it's a benefit, is the Georgia deduction. Otherwise, you could do a backdoor Roth with all the money. Well, interesting. I had never heard that one. That is a new one on me. Thanks for that. Let's get another question, shall we?
I'm asking this question for my dad. How easy is it to manage my own traditional IRA and the required minimum distributions in an account through Schwab or Vanguard? The IRA is currently being managed by a different company, and the money is divided into a very complex portfolio. I'm thinking it would be much smarter to move it to Schwab or Vanguard and manage it myself to have a much smaller expense ratio, maybe just putting it into VT and B&D based on the risk quiz score. The main question is, will Schwab and Vanguard know what those minimum distributions need to be, and will they tell me each year, based on my age, what that number is? And if they do know what that amount is, when and how will they share that information with me? I've learned a lot from you guys in the past, and I look forward to your response.
This is so easy, and this is really a good solution, too. Get out of the broker, lower your fees, have a simpler portfolio, and yes, both Schwab and Vanguard have very robust required minimum distribution calculators. As a matter of fact, they will both even, through their website, set up required minimum distributions. Easy for me to say. Automatically. They'll just make it happen. You set the whole thing up. You just look for their RMD calculator. You set the whole thing up and you say, all right, send me this much from these accounts at this interval. And they will make that happen. They vary a little bit in how they do it, but they both have some sort of automatic distribution set up in their websites so that it is beyond easy. It is so simple. It's probably easier than having a broker with a complex account. And so I would absolutely suggest that Dad make that move. Thank you for your question. Let's do another one. That was fun.
Hi, Don. This is Joe in Wisconsin. Say, I've got a question. I'm helping my parents out with their retirement. They're in their mid 70s and they're part of an investment club. And my understanding is it's set up as a partnership. And they need to start drawing income from this. It's about 30% of their total investable assets in this thing. And so I said, they should do a in-kind transfer of shares so they can start slowly selling them, realizing capital gains, control their income to stay in the lower tax bracket. The partnership and the investment club is at Charles Schwab, and Schwab said they won't do an in-kind transfer to an individual account from a investment club partnership. If they just take money directly out of the club, I guess the gains get spread amongst all the members, and they've been in this since like the 1980s, so it's 40 years of capital gains. Just wondering if you've ever encountered this, if you have any thoughts of how to do an in-kind transfer from a partnership that's set up like this, that's an investment club. Thanks.
No. Because of the way this is set up, these are set up as general partnerships, like a real business. You don't own the shares as a member of the partnership. You own a share in the partnership. The partnership owns the shares. Therefore, any taxable event accrues to the partnership and has to be reflected on that blasted K1. So it makes for a tax nightmare every year. It does create taxable events, and it's all based on the partnership's tax situation. So, in other words, be happy for the gains, but there's not a darn thing you can do about the taxes. I've heard of this. I haven't talked about it in years, many years, because I don't like investment clubs. I think they're foolish. I think they're perpetuating the myth that a bunch of smart people getting together can make money. Well, anybody who invests in the stock market and does it for a long time has in the past made money. But your folks probably would have done as well just investing in a mutual fund, which is kind of like a big investing club, and could have better controlled their tax situation getting out. So I am confident there's no way that this investment club is going to let that happen, or that Schwab is going to let it happen. Can you imagine the bookkeeping nightmare that would be for Schwab? Anyway, I am really sorry. No, taxes must be paid. They're part of the cost of doing business, of being citizens. We got to pay them eventually. They got it kind of deferred, though. All right, let's see. Well, darn it, all good things must come to an end pretty soon, and this episode of Seasonal Q&A is going to do just that after this next question that was sent in at talkingrealmoney.com.
Hey, Tom and Don. I appreciate your guys' outstanding work. So my question seems simple enough, but it rarely gets answered directly. So for the stock portion of my portfolio, what percent should be in U.S. large cap? Everyone seems to default by kind of backing into this answer by asking questions like, how much international should I have, or how much U.S. small cap should I have, and then kind of figure out from there. But I currently have about 30% of U.S. large cap, but some people have told me that's too light, and that's for the stock portion of my portfolio. But I believe in getting exposure to things like international developed, emerging markets, U.S. small cap blend, even a U.S. Small cap value tilt, and even some REITs. So, it's difficult to get decent diversification with all those if my U.S. large cap, starts to exceed about a third of my stock portfolio. So, that's the question: is how much U.S. large cap? Thank you.
Well, as with everything, there is no definitive answer. You're going to get different opinions from everybody you talk to. Now, generally speaking, the U.S. total market is about 70 to 75% large cap stocks. Okay, so we start with that. About 3/4 large cap. Of the large cap, generally about half is growth and about half is value. That's a rough figure. So, about half of your, if you want to match the market, about half of your portfolio of equities, about half of your large cap portfolio of equities would be in large cap growth. So maybe 35 to 40% of the whole portfolio, but we believe in a value-oriented tilt, so that means less in small cap growth. Avantis probably has, and they don't break it down. They don't really give us good breakdowns, but they probably have in their AVGE fund, because AVGE is 40 some odd percent the U.S. large equity. So let's say that's going to be less than half and half. It's probably going to be 30% of that. And then they have a large cap value fund, which is 15%. So let's say roughly, I don't know, it looks like, we're in the 10 to 12% range of large cap growth, which is interesting because Paul Merriman, good friend of ours and a calculator of portfolios, has for years had an ultimate buy and hold portfolio of 10 funds. And that portfolio basically has about 10% in the S&P 500. So really about 5% in large cap growth. So he's saying large cap growth is a tiny percentage of your portfolio, U.S. large cap growth. Even international large cap is going to be, altogether between U.S. and international, with Paul's portfolio, it's going to be about 10% in large cap. So that's your rough answer. There is no definitive answer. If you want a value-oriented tilt, though, you're probably looking at somewhere between 10 and 20% in large cap growth, and then the rest of it in value-oriented small cap, that kind of thing, emerging markets. I hope that answered the question. And by the way, thank you all for the kind comments. We really appreciate how much you enjoy the show. And we would really love it if you get a chance, if you go to Apple Podcasts and write a review, because some people just get really, really mean. I mean, downright, they call us names. And I have a thick skin. I'm okay with it. I really am. I mean, I've been a talk show host for 40 years. I've had people call me horrible things. But it's really funny. If I disagree with them, then I'm an idiot. Isn't that funny how you're an idiot if you disagree with somebody? I wouldn't mind if they said, yeah, I disagree. I enjoy the show, but I disagree with them. But it's like, I disagree. Don's an idiot, 1 star. Because they're trying to make our reviews look bad. So if you like us, knock those kids down a peg. They're not really criticizing the show. They're just saying we don't know what we're talking about. And it's generally around issues like Bitcoin and fiat currencies and government conspiracies and that kind of crazy stuff. But, do what you want. It'd just be a nice little holiday gift for us. Not that it means anything in the long run. Thank you all so much for being there, for listening and telling friends about the podcast and participating in it like you've done for this one. And this is the last Friday Q&A before Christmas, so Merry Christmas and Happy New Year. Happy holidays. Have a great time with family and friends, or if you're like my wife and me, just with each other because the family's all elsewhere this year. We're thinking about going to Typhoon Lagoon for Christmas. We're going to have a wet and wild Christmas because we can't get into the parks. Our passes are all blocked out. We live in Central Florida. All right. I'm at the end. Go to talkingrealmoney.com and ask some questions, or call us on Saturdays at 855-935-TALK between 3 p.m. and 5 p.m. And have a great holiday. I'm Don McDonald. And while you're celebrating the holidays, make sure every once in a while you get together, when you get together with people, that you're talking real money.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.